The first step to correcting this mistake using method 1 is to post a reversing entry. In our original erroneous entry, we had a credit to cash. So what we'll do is we'll debit cash for the same amount to bring it back to what it was prior to our last journal entry. And we had a debit to office supplies. So what we do here is we credit that same account to bring it back to what it was prior to our incorrect journal entry. So my note here is going to be reversing journal entry, JE for short, to fix error. So basically I'm bringing back the account to what they were before my error happened by making this correcting journal entry. The next one is going to be a do-over, essentially. Note that the cash and office supplies are both returned to the previous balances. The incorrect journal entry has now been wiped out. Now we can get to the second step, which is making the correct journal entry. So this is the entry we should have made in the first place, right? We should have debited furniture for $1,000 and then credited cash also for 1,000. And once again, I write a brief description, journal entry to correctly record furniture purchase. So in instances like this, the descriptions are very, very helpful, because if anybody were to look back at the journal entries and wonder what the heck is going on, well, it will be easy to track. On the same day you had your first entry, which was a mistake, then you had your second one, which is a reversing journal entry to fix the error, and then you had a third one, which recorded the purchase again, this time correctly for furniture. This entry brings the account to their correct balances as a result of the furniture purchase, or cash decreased by 1,000 and our furniture account increased by $1,000. So looking at the one-step correcting entry, if we look at our first entry, we note that the cash credit was done correctly. The incorrect part of that entry was the office supplies debit. So we know that office supplies should now go down and furniture should go up. So we can do a one-step entry just by moving office supplies down and furniture up. So when we move furniture up, we do a debit of 1,000, and then to bring office supplies down, we will credit that account for 1,000, and the description will be similar to our last correction. Journal entry to correct May 13th. Journal entry. I'm going to write down furniture purchase. Okay, so that's a couple ways you can fix an incorrect journal entry after it has been posted. Moving on to the next section, classifying assets and liabilities. On the balance sheet, assets and liabilities are classified as current or long-term to show their relative liquidity. Liquidity is a measure of how quickly an item can be converted to cash. Cash is the most liquid asset, followed by receivables and inventory, since they can be converted to cash relatively easily. Long-term assets, such as land, buildings, and equipment, are difficult to convert to cash, so they are considered to be relatively illiquid. So current assets are any asset which are expected to be converted to cash or sold or consumed during the next 12 months or within the business's normal operating cycle if it's over 1 year. In this course, we will assume that 12 months equals current. We won't worry about the operating cycle aspect of this. So some examples of current assets are of course cash, accounts receivable, inventory, and supplies. So those are things you can reasonably expect a business to either collect, use, or sell within the next year. What is an operating cycle? It's a time span during which cash is used to acquire goods and services, and then certain goods and services are sold to customers. And three, the business collects cash from its customers. So basically, if you think of it as a simple dollar store model, you import something from China, you sell that something to your customers, and you collect cash from your customers. It might be right when you sell the product, or it might be a little bit later, but it's expected to happen within 12 months. Some long-term assets, or assets which aren't classified as current. These are called property, plant, and equipment, or PP&E for short. Current liabilities are liabilities which are due to be paid within 1 year. Some examples are accounts payable, salary payable, interest payable, taxes payable, and unearned revenue. And long-term liabilities, liabilities which aren't classified as current. And a good example of that is notes payable, which are debts typically due a long way from now. Looking at two accounting ratios as we wrap up this chapter, some common accounting ratios are used by various users to make decisions around investing, lending, and supplying. The current ratio, which is the ratio of an entity's current assets to its current liabilities, measures a business's ability to pay its short-term debt obligations. So current ratio, you see the formula over here. It's total current assets divided by the total current liabilities. A higher current ratio indicates a better financial position. Most successful businesses operate with current ratios between 1.3 to 2. And then we have a second one, which is I think is easier. It's the debt ratio, which is just total liabilities divided by total assets. So a low debt ratio is safer than a higher one. So we have an example here of Danielle's umbrella company. So we're comparing 2 years, 2021 with 2020. And the way we're going to calculate the current ratio is first to identify anything that is a current asset in this table. Then down below we have a table of liabilities. And over here we will be identifying first and foremost what is a current liability. Once we have those, then we can actually do the calculation of figuring out what the 2020 current ratio is first, and then the 2021 current ratio. And then once we have the final numbers over here, we can compare them and decide if the current ratio improved in the year 2021. So how does it compare to the last year? And then we'll look at a debt ratio. This one is easier, in my opinion, as I said, because you just take the total liabilities and divide by the total assets. And once again, you get two numbers, and we compare them to see if there was improvement in 2021. So take a minute to do that. Go through the two tables, identify what's current and what's long-term, and we will cover that in the next video.